Hello friends, how are you all? I hope you all are doing well and fine. Now, I am Anushri Deshpande. I am a CA final student. Welcome to my channel. My first video pertains to basic rules of accounting. Now, I hope you all are able to understand the basic rules of accounting. Now, this second video pertains to Bank Reconciliation Statement BRS. How to prepare bank reconciliation statements. So, firstly, the basic and most important thing under BRS to understand is, under BRS we have to reconcile our balance as per cash book with balance as per bank statement. So we have to arrive at balance as per bank statements from balance as per cash book. So there are various kinds of transactions done in our bank statement. Let's pick up first transaction. Interest debited. And for certain transactions, interest are being debited in our bank statements by the bank. So the interest debited, the same needs to be deducted from our balance as per cash book. And most importantly, remember one thing: if the interest debited or the interest which has been debited is already been considered in our books of accounts, which means the same has been considered, the same has been debited to our P&L account, then no need to consider it again, otherwise double effect will be given. So this is the basic rule, that if the effect has already, for given transactions or of any nature, of any kind, if the effect has already been considered under our books of accounts, then the same needs not to be considered while preparing the BRS, because this, for example, interest debited, like if the interest has already been debited to our P&L account, which means the same has been deducted, then why need to consider it again? So we don't have to consider if the effect has already been given. So the same rule applies for all my next transactions. First, interest debited. The interest debited, which means the interest has been deducted in our bank statement. So the same needs to be deducted from balance as per cash book to arrive balance as per bank statement. Simple logic. When the interest has been credited, same, if the effect has already been considered in our books of accounts, no need to consider it again. But the effect is not considered, then interest credited needs to be added since it is an income. So the same needs to be added to our balance as per cash book to arrive at balance as per bank statement. So if the balance as per cash book is, say for example, 100 rupees and interest balance as per bank statement is 110, and there is one transaction like interest credited of rupees 10. So if we will add that 10 rupees which is interest credited to our balance as per cash book, we will arrive at balance as per bank statement. As simple as that. The same rule applies for checks received. Checks received. If the checks has been received, if somebody makes us payment through checks and the same checks has been cleared, like the same checks has been credited in our bank, then if the effect has not been considered in books of accounts, then consider. Otherwise, double effect will be given. So, if the effect is not given, then add the same to balance as per cash book to arrive at balance as per bank statement. Next, checks issued, payments made. If we make payment to somebody through checks, then the same are debited from our bank account. So if payments are made and the effect of the same has not been considered in books of accounts, then only consider. If already the effect is considered, no need to consider it again. So now, checks which are debited, same, deduct from balance as per cash book to arrive at balance as per bank statement. Bank charges are also kind of expenses, indirect expenses. Certain charges are deducted by bank on various transactions. So, bank charges, same, if the effect has not been considered under books of accounts, consider. Bank charges needs to be deducted from our balance as per cash book to arrive at balance as per bank statement. So keep the basic rule in mind that if the particular item has been debited to our bank statement, debit the same, which means deduct the same from our balance as per cash book if the same has not been considered earlier in our books of accounts. And secondly, the same rule applies whatever items has been credited in our bank statements, the same are needed to be added to our balance as per cash book to arrive at balance as per bank statement if the same has not been considered earlier in our books of accounts. So simple logic, whatever has been debited, debit the same, deduct the same from cash book. Whatever has been credited in bank statement, add the same to balance as per cash book to arrive at balance as per bank statement. As simple as that, if the effect has not been considered in books of accounts earlier. So guys, this is the basic knowledge pertaining to BRS, Bank Reconciliation Statement preparation. Trust me guys, it is very easy, logical, and it is fun to prepare BRS. So if you have any questions, ask me in the comment box. And if you like this video, please share and subscribe my channel. Thank you so much friends.